Welcome everybody to our first official podcast of the Hendriks Experience. I'm so honored today to have Tyler Hibbs here, a mortgage agent with Mortgage Architects. Did I say that correctly?
Correct. That's absolutely right.
Awesome. So, hot topic for the last couple of years has been interest rates.
Absolutely.
So, they've been wonderful for a number of years. They were super low. They were down to under 3% to under 2% even. And then suddenly we had this big change. Can you tell us a little bit, Tyler, about where we've been at as far as interest rates are, where we are currently, and where you feel we're going to be going?
Yeah, absolutely. Like interest rates actually go hand in hand with the housing market, right? And there's opportunities there are when low interest rates, there's opportunities with high interest rates. And the reason why I say that is that when rates are really high, we have one of the largest pool of buyers, which are investors, not buying because cash flow doesn't make sense, right? So rewind 2 years ago, 3 years ago, when your example rates were sub 2%, cash flow makes sense. We have pressures in the market, demand goes up, right? Now we have opportunities where first-time home buyers never had that opportunity to buy, super competition, housing over, XYZ over the asking price. And now we have the opportunity, less demand, so less, still a decent amount of product on the market, but less pressures from investors buying, and they have the opportunity to finally buy. So it's kind of like hand in hand where interest rates go tied with the housing market.
Right, absolutely. So jumping back a couple steps to COVID, March 2020, the day the market died, and for a short term, because back then, everyone thought that home values would plummet with COVID, and I'm probably actually one of the very few that actually did a video and felt that interest rates would start coming down, which they did. The government started bringing interest rates down to a very low point, but that a lot of people would change their lifestyle, and it would bring in this huge influx of new buyers into the market, as well as people coming in from the GTA into our market, and that we'd have that surge of activity. And so, but what that caused was so much action, so high of quick acceleration of prices that the government started increasing the interest rates. So it went from such a challenging market with such low interest rates and competing offers, like we were seeing 10, 15 offers on a property was quite common. And now it's just a different challenge.
Absolutely. Now the affordability really comes into the play, right? So again, kind of go back to the investors knock on the market. It's not only like cash flow, but it's also affordability, right? So we have interest rates increased by 300% to 400%. No one's wages has gone up that much. So now we have interest rates increasing. Housing has not dropped 300%, right? We've seen in Niagara, the last 2 years drop 15, 20% maybe. So there's still a big disconnect, right? So one common question I get often is like, should I buy now where rates are high, right? And maybe we've seen rates have increased by 300%, but housing has dropped by 20%, or should I wait until rates actually come down? There's plus and minuses on both hands. If we look at a house that sold sub 2% for $650,000, right? Versus today, the same house is worth, let's just say $525, but the rates are, instead of 2%, let's call them 5.5 or 6%, right? So cash flow was in terms of like monthly cash flow was better in the previous COVID years.
Yes, right? Absolutely. Those monthly payments were so low. It brought so many people into the market and affordability.
Absolutely.
So just like the hot topic today is, affordable housing. So with the qualifying higher interest rates, it's brought people out of that zone that they're qualifying. And that's a big stressor. It's a real stressor for people.
Absolutely.
And it's our biggest challenge right now for a lot of people, and especially in that lower income to middle income. Certainly people that have done very well, invested, built their wealth, they're not challenged so much by the interest rates, right? But it's the majority of the people in that lower to mid income bracket that's made it a very difficult time for them.
Yeah. The tough part is if they wait, the issue could be that they get priced out, right? Like eventually we're waiting for a perfect point and we're probably in it or very close to, where interest rates are, even just the whisper that rates are going to be coming down. We've seen the last couple of months that like the housing market has really come a little bit on fire, right? So we've seen more action in it, and we haven't even dropped rates yet, really. At least in the variable markets. Fixed rate mortgage, we've seen long-term bonds obviously start to drop. So people are starting to like look at fixed rate mortgages, or definitely because we're starting to see better pricing on them. But really the market rates haven't adjusted drastically, and just the whispers of rates coming down has made a little bit of a tempo pickup in the market. If you could.
Yeah, I think what happens is it starts to build a little bit of confidence, right? The confidence was lost. The challenge of affordability and qualifying is lost. I believe we saw the market bottom out right in November, December. The average sale price in Niagara did not show an increase, but we certainly saw that increase in activity right out of the gate, right after Christmas. A lot of times people, they're sitting around the Christmas table and having dinner, and they're starting to talk about what their plans are for the new year. And they're starting to talk about possibly making a move. And right at about that same time is when they started talking about, okay, we're going to start to see in the new year, 6 months, 8 months, we're going to start to see some mortgage rate decreases. So right out of the gate after Christmas, I felt into the new year, we certainly saw this like mini little, I'm not sure if I'd call it a surge, but definitely an increase in activity right out of the gate. So I think that's going to transpire into starting to see an increase in that average sale price. Sure. And as you mentioned, the interest rates, knowing that those decreases are coming, I would call it the early adopters of our market.
For sure. That was actually my next question. Like, what types of people are calling your phone, right? Is it first-time home buyers and investors? Is it people that just want to upgrade and take advantage? Like, I know from the application side, we're kind of seeing, like, it's pretty colorful. Like, we're seeing first-time home buyers that are trying to get in the market because there's less competition. We have early adopters that are investors that are trying to buy low while the rates are still high, maybe float the variable, do a short-time fixed rate. And also we're still seeing people that want to make that next, maybe they bought their first house, 3 years ago, they want to make that next move into their 10-year home or something like that. And they're seeing it at a discount, but that's what I'm seeing on my side. Are you seeing something similar?
I think as a team, we're seeing a little bit of everything because our team is very diversified. So we work with a lot of first-time home buyers. We work with people that have bought, sold, made a number of moves in their years. And we're also dealing with investors. So we're dealing with a little bit of everything. And I think, though, that the investors, for the most part, are still sitting on the sideline. And honestly, I think that's made a little bit more challenge in the condo market, investor market. And I think more of the starter homes are going to have the first pickup. And I think that a lot of investors who maybe purchased pre-con a few years ago, those homes are starting to close. They're into negative cash flow.
Yeah.
And so they're trying to get through that right now. So I think they're just more focused on that than getting back into the market. But as rates do change, and as we see them change over the next 6 to 12 months, that's when the investor is going to come in. And that's that added amount into the market for the number of buyers that push the prices higher. For sure.
So I would just that comment. I absolutely agree. I think it's a good window for first-time home buyers to get in before the vast majority of investors step into the market. Obviously, we have that less competition. The thing also with investors right now is again, if they have a portfolio or trying to build a portfolio, most of them probably already have something they're leveraging on their properties to buy because housing is still relatively high. But for the most part, they're probably negative cash. There's a potential there's negative cash flow. If they went variable, for example, and they didn't lock in, they're negative cash flow as it is. So they still don't have that opportunity to come into the market because all their properties might be underwater, or the fact that just servicing, maybe they are cash flow, depending on how long they've had the properties, what rents look like. But maybe it could be just the fact that they are they can't afford to. So it becomes affordability, right? Okay, maybe even a property does come cash flow or not, but it's being able to actually afford, then get approval from an actual lender that could make the difference, right?
Right, exactly. Because even if you're an investor, you're still going to the lender to get approved. And, you have a number of properties. You're very fortunate that you are building your wealth through adding additional real estate into it. But it just makes it even that much more challenging to get that qualification completed.
Yeah, and that's what we're seeing. We're doing lots of pre-approvals. Some, again, the early adapters are really trying to pull the trigger, find the right opportunity. Rewind to the COVID times, they don't have that ability where if the right opportunity came up, you had to go all in and above the asking price, couple, thousands and thousands of dollars. Now they have the ability to pick and choose a little bit, but it's still the affordability piece, which is really holding back the vast majority of it. The top income earners or the people that have the affordability are really not seeing that. We're still doing those purchases, but affordability is still tough right now. So the people that want to get in the market there's still going to be some holdbacks until the rates actually do drop.
Absolutely. So you're not going to have that sheer volume of people quite yet because of that limitation on being able to qualify. But we do share with people, the best time to buy is when you can qualify, and watch the market. Work with a realtor who really is experienced and watches the market every day. I love all realtors and everything else, but if you're a part-time realtor and you're selling a few homes a year, that's not going to be near as the experience that you need who's someone in the trenches every day, watching the active listings come on, watching the pendings, watching the closings, and really having a really great pulse in the market. I think that brings tremendous value to a home buyer. They're looking for that expertise out there.
Absolutely. I absolutely agree with that. Even on the mortgage side of things, I mean, we're seeing still relatively high prices with very high interest rates. So affordability is just an issue across the board, really. So working with a mortgage broker rather than dealing with like your institution that possibly you've been working with for 20, 15, like whatever, 15, 20 years, maybe the case. Having, we need those niche little products to really qualify people to get in the door if you're a first time home buyer, or whether it's like really taking advantage of that low property price that would make sense for cash flow purposes, like having those alternative products. Like historically, majority of our book of business in the mortgage space that we've been, a large amount of brokerages come from the broker side, come to the A space. So the big banks, the big credit unions, the banks that we all know. The last year,
for those who don't know A space, when you say that term, maybe explain a little bit between the different types of lenders out there. Yeah, but your A lender, your B lender, your private lender.
Yeah.
Can you share a little bit about that to people who may not be as familiar with that?
Yeah, absolutely. There's 3 different sandboxes that we play in as a mortgage agent or mortgage broker. And there's the A space, which is like all the institutions that we know. So the big banks, the big credit unions. And the benefit of working with them is that they're the most competitive rate. The downside is that they actually have like the smallest box to fit in, right? So if lenders focus on 3 different things, which is credit, affordability, and down payment, really, there's other things that go into, but if I were to kind of limit to the 3 different boxes, those are the 3 things that you hit. And the A space lenders, like, again, they have the best rates, but in terms of like where they fall into, they're the hardest to get qualified for, whether it's affordability or bruised credit or, other circumstances with down payment. And then the second box is alternative lenders. Now the benefit of that
is that what you're referring to as a B lender?
Yeah. So B lenders. Yeah. Yeah. Alternative or B lenders. Right. So we're finding a big shift into that market just because of affordability. It's not like we're seeing like, larger bruised credit. It's most the fact that like the GDS and TDS, which are the 2 parameters that the lenders basically gauge in terms of affordability, are out of line because of interest rates. Right. Like I said before, our interest rates have increased by 300%, 400%, but no one's wage has gone up that much, right? We're still seeing 2-3% in terms of increases in wage, right? So we have obviously a disconnect to what people can afford. So we're seeing a larger shift from the B lenders or the A lenders into the B space, right? And the downside is that like, the downside is there's a premium to the rate, but we're doing shorter term. So like, even if we do a 1 year with any of the big 5, in terms of like parallel, they're really very, very close in terms of rate. Where it really comes down to is that but what makes them different is their affordability is kind of open up slightly. The C space, the private space is just a little bit different altogether. It's more like circumstances, the properties damaged or like a kind of very, very bruised credit. So there's more of a backstory to that. But traditionally, we kind of follow ourselves in the A and the B space. But a big shift into the B space the last year, not given due credit issues, it's just affordability for the most part.
Right. I think sometimes for those that are not maybe of a much younger age, think of mortgage agents and going to mortgage broker. Oh, well, that's where you go if you got terrible credit. You can't get a mortgage anywhere else. But times have changed, and that's certainly quite different today. They used to have to pay a lot of fees. Can you explain a little bit? Because I don't want to see that people think it's a negative. It's quite the actually opposite. So it's a great idea to go see a mortgage broker who can shop that rate around and who can give you a lot of awesome advice, just like a great realtor can give you great advice.
Yeah, there's if you walk into your financial institution, what usually your day-to-day bank, and I can speak to that pretty freely because I used to work for a local FI for 6 years. And
FI again.
For financial institution. I'll make it even easier, like a local credit union. But For the, like when I worked there, I wore 10 different hats. I did wealth management, I did small business banking, I did mortgages, and like anything on the retail banking side, so like opening up accounts and sending wires, et cetera, et cetera. So I was a generalist of 100 different tasks and duties. And now we're a professional in just one site, sign a site, right? So where if I worked for that financial institution, I would have to know like, hey, what's going in the market because I did wealth management, or was there changes to small business procedures and loans and stuff like that? It's impossible. There's not enough hours in a day. So now just specifying just with one thing, we're a professional at one craft rather than just a generalist in many, right? The difference is really though at the end of the day is like we just have more tools in our toolbox, right? If every lender was painted with the same brush, then that like no one would have specialty programs or niche programs, right? So there's a very good chance that someone could walk into, I'm going to give an example of like BMO and get a pre-approved for 500,000 and they pick up the same income, same debt, same calculations and go to a different institution. They could be pre-approved for more. So why is that? They just all have different rules and policies, and spending like depending on their specific situation or financial picture, that differentiates. Well, there's a very slight chance that you're walking into the right institution that fits your box, or you just go to a mortgage broker or mortgage agent that has all those tools in their toolbox.
Right. So basically, instead of just going to one place and hoping you get lucky that you hit it right on with the right circumstances and the right rate, they can come to you, no cost. And then you go out and search that out for them.
Absolutely. And the thing is like interest rates is such a hot topic. So in Niagara, I'm very familiar with the Niagara market. I've done mortgages in Kelowna and St. John's, Newfoundland, but like I'm very familiar with most of the clients I see with, we go to a certain institution because of a product that they offer, right? Even though there might be a premium to the rate, like by 0.05%, right? But it's the product that we go to. If you're the type of client that you check all the boxes and affordability is in line and you kind of like your income is pretty standard, then like, again, to that point, you have to basically bank on that you're walking into that institution that offers the best rate, right? Well, we have options to, 50, 60, 70 different lenders, right? Depending on what our relationships are like.
Right. And when you say that, Tyler, that they might pay a little bit higher rate, but they're getting some other benefits to that. Can you delve into that a little bit more about how that would look and why that would be?
Absolutely. So, child tax benefits, some lenders will take 30% of that, right? Some will take 100%. So it's like, there's the affordability aspect.
You mean as far as for qualifying? You're trying to get that income level up as high as possible so that you can maximize your qualify. Not even maximize. It's not like nobody's like, we're trying to get them to spend more money, but just to get to a level that gets them in the door into a property.
Absolutely. There's still lots of buffers in place in the application. We stress test, et cetera, but there's like default insurance, which obviously impacts your amortization. There's lots of buffers in place, but in terms of like, obviously we have the affordability question, right? Can you handle the payments? That's the most important thing.
Absolutely.
The second, but in terms of like what can we offer in terms of like, or what differentiates, I guess, in terms of lenders, not really us versus a mortgage broker. We're just comparing like ABC lender to XYZ lender, really. So the difference is that like, in terms of affordability could be different depending on what institution you walk to. My example is if you have child tax benefit, some lenders will only take 30%, some will take none, some will take 100% of it. So it depends on the situation. On top of affordability, prepayment is a popular one. So prepayment's like, hey, so I have extra money, what can I do with it, right? Or I want the ability to, max on my amortization, which makes my monthly obligation as low as possible. But also I want the ability, if like I have extra cash, can I put money on it, right? So that's a hot topic right now, especially people coming up for renewals are like, holy smokes, I was paying 2.5%. Now I'm paying, I just got my renewal from XYZ bank and they want me to roll into a 6% mortgage. Well, obviously that impacts your payment. So what tools can we do to limit your obligated payment, but not push back the amortization as long as possible? So we do things like, you have extra money you can put directly against the principal, which lowers your amortization. You can go from bi-weekly to accelerated or weekly to accelerated to shorten your amortization. Or you can increase your payments really, if you want to, just obviously to make sure your amortization is not all the way because you're gonna be paying a lot of interest that way. So there's multiple different reasons in terms of just like rate affordability, why a mortgage agent or broker would be competitive rather than just walking into one institution.
Absolutely. Very well said. Now, let's jump back over to interest rates and where they're at now and where they're going. We're having a conversation with a lot of buyers. We're talking about lock in for like just 6 months, about a year, maybe 2 years, but that's about it. And don't lock in for 5 years right now because the mortgage rates are going to be coming down. Now, you may need to do that in order for qualifying. What's your general advice and opinion to new home buyers coming into the market now as far as the term that they should be looking at, and what do you advise them on in that regard?
For sure. If affordability is, the stress test really impacts affordability. Okay. So we used to, when the stress test came out, is a flat rate, 4.79%, and everyone just had to qualify 4.79. Doesn't matter if you're doing a 6 month, a 5 year, a 10 year, a variable, 4.75, 4.79. And then when rates were increasing, we obviously jumped it up at 5.25. Now rates are above 5.25. So what they just basically, they said, it's not going to be a flat rate. It depends on product. It's just 2% higher than whatever your rate is, right? So the reason why I'm bringing this up is that, like, if a 5-year fixed rate now is 4.99, that client qualifies for 6.99. Okay. Different product. They want to go variable because they know rates are going to go down. Okay. Variable rates are at 6.4%. So that means they qualify at 8.4%. Okay. So you're qualifying for much higher, means your monthly obligation for that qualifying payment would be higher, which then eats up more of your income, which then increases those two parameters that lenders look at, GDS and TDS, which then impact people's purchasing power negatively. So someone could walk up to me and say, what's your best rate? Or what can I be qualified for? Depends on, like, what you want to do with the house. If you're going to turn and flip it, then I'm not going to do a 5-year fix of 4.99 and qualify you at 6.99. I'm going to, right? So what you can qualify for and what we advise on are two different things. If the client kind of affordability was not a problem, we're looking for shorter terms. We're looking at, the sweet spots, definitely less than a 3-year, but in terms of, like, pricing, the 3 year is the most competitive. Okay. So historically, like, I'm going to give you an example. A 5-year, if you promise the bank 5 years of your business, you'll get a good rate, versus like a 1 year where the next year you're up for renewal. Then what happens? You could leave, whatever the case may be. So they're not going to give you a favorable rate. Historically, what happened is that, like, if a 5-year was at 5%, as example, a 4-year would be 5.1, a 3-year would be 5.2, 5.3, 5.4, right? What we're seeing is, because rates are so volatile, lenders are obviously taking advantage of this. These are publicly traded companies. They're in it to make money, right? Off me and you, right? So they have to show their shareholders that they're in it to make money, or not in it to make money, but they have to make money. So what happens is because there's so much pressure and volatility that it's coming with rates, we're not seeing that 0.1% between rates, like a 5-year, a 4-year, a 3-year. We're seeing larger gaps on the shorter rates, right? So for example, if we do a 1 year at like 7%, a 3-year is at 5.5. So it's a huge spread in interest rates, right? So that gives up a ton of affordability, because you're now being stress tested 1.5 higher than that in interest rates. So if affordability, kind of going back to your original question, I kind of want to look crazy there.
I have to tell you, Tyler, you packed a lot of information in there. So I think that people might have to re-listen to that.
Oh yeah, no, for sure.
That was a lot packed in there, a lot of awesome information. If someone wanted to reach out to you, how would they contact you to have a little bit more personal one-on-one conversation with you?
Yeah, for sure. So, like, my contact information will be just on the bottom of this, so they can feel free to reach out by it's somewhere down here below. Feel free to reach, like, email, text, or phone. I'm like anyone else. In this day and age, my phone is pretty much attached to me at all times. So, feel free to reach out that way, and then we can get the conversation started. My big part is just education. I want to meet with, it doesn't matter if you're a first time home buyer or you've had 10 homes before. My process is the exact same for every single client. That's like, this stuff is not taught. We were taught that we would never had a calculator attached to us at any time. And we learned long division, all this stuff. And guess what? Now we have cell phones, but we weren't taught, like, how to do your own personal taxes, how your credit score impacts anything, how to apply for a mortgage. So I like to fill that gap and basically, like, educate, and everyone has a different circumstance. So I like to fill that gap and make sure that they understand what they can do and what that means for them. So
awesome. And what we'll do is we'll break these topics down a little bit more as we move forward into more podcasts. We'll have you back. We'll talk more about mortgages, interest rates. We got a good run coming up, and we're just all hopeful that the rates are going to start to turn and start to come down and make affordability, get affordability back for people, that they can get into the real estate market. Thanks so much for joining us today.
Appreciate having me.
And we look forward to having you here again.
Absolutely. Looking forward to it. Thanks.